Hello friends, welcome to the world of accounting and our today's topic is adjustments for final accounts. Okay friends, now introduction. There are two main elements in final accounts. First is trial balance and second is adjustments. Now friends, the trial balance have one effect. It can either be debit or credit, but adjustments have two effects, that is one debit and one credit. Now friends, there are three common adjustments. First is closing stock, depreciation and the RDD. Now, the first effect for closing stock will be balance sheet asset side because we have write on our stock. So that is our asset. Okay. And the second effect will be trading account credit side as in closing balance of our stock. The second adjustment is depreciation. Here the balance sheet less from specific asset and profit and loss account debit side because it is a notional expense, so it will be debited to profit and loss account and less from specific asset as its wear and tear for using it for a period of 1 year. And RDD balance sheet less from debtors and profit and loss account debit side there is a specific format for it, that is bad debts add new RDD add new RFDD less old RDD. Okay friends, now other adjustments. Outstanding expenses. Outstanding expenses means what? The expenses which are not paid and it is payable. Okay, so it is our liability. So the first effect will be balance sheet liability side, where second effect will be profit and loss account or trading account add to specific expenses. Now outstanding income, income which is receivable. Okay, so it will be balance sheet asset side because we have write on that income, and profit and loss account add to specific income on credit side. See, normally prepaid expenses will be balance sheet asset side because it is prepaid, so we have write. Okay, and profit and loss account or trading account less from specific expenses because it is not of current year, and in profit and loss account we only write the entry of a single current year. Okay, now pre-received income, it is our liability that we have pre-received any income, so it is liability and it will go liability side in the balance sheet, and the second effect will be profit and loss account less from specific income. Okay friends, now interest on bank loan payable. If the bank loan is payable and it is your liability, so first effect will be balance sheet liability side with the profit and loss account debit side because it is your expense also. Bills payable dishonored. Here bills which are payable are dishonored, that means your creditors increases, so add to creditors, and your bills payable will be decreased because you have not paid the bill. Now bills receivable dishonored, that is your debtors will increase, so add to debtors in balance sheet, where the second effect will be balance sheet less from bills receivable because the bill is now dishonored. Unrecorded sale. Now you have not recorded the sale, that is you have done any credit sale and you have not recorded it, so add to debtors because it is credit sale, and second effect will be trading account add to sales. Okay friends, now unrecorded purchases. If there are certain unrecorded purchases, the first effect will be balance sheet add to creditors, whether the second effect will be trading account add to purchases. That are simple. Now personal expense. The personal expense are different from business expense, so we have to not record our personal expense in final accounts. So the first effect will be profit and loss account or trading account less from the specific expenses which have been made and which have written in the book and which is a personal expense, so it is not allowed as per expenses. And the second effect will be balance sheet less from capital as drawings. Now here the depreciation is different, which is a hidden adjustment. We say it because it is a hidden adjustment, because if the asset is purchased in middle of the year, so we have to record the entry from the year which it is purchased and ready to use. Okay, so if it is purchased after 6 months, so we have to charge depreciation only for 6 months, that is remaining 6 months which is for which it is been used. So the first effect will be less from amount of fixed asset, and second effect will be profit and loss account debits as above. Here the calculation is very necessary and important for getting correct depreciation amount. Okay friends, now good destroyed by fire, by any of the thing like fire, theft, anything of XX amount, and claim received of YY amount. Here the first effect will be trading account credit side by XX amount because the goods which have been destroyed are gone out and credit what goes out. So here trading account we have to credit it. Whereas the second effect will be profit and loss account, debit side, xx minus yy amount, that is your net loss, will be debited to profit and loss account, where the claim you have write on the claim, so it will go in asset side, like claim received claim receivable yy amount. If goods are sent out of the organization in way of sample, advertisement, or in case of theft, so goods are going out, so you have to credit the trading account, where the profit and loss account should be debited because it is total loss of yours and you are not getting any claim. Okay friends, now if you like this video, then please subscribe it. For any accounts out, please comment in the comment box. Thank you friends.